Hello student, welcome to the lecture on capital structure and cost of capital, and after this lecture we will be able to learn the following objectives. Understand the capital structure management, describe theories of capital structure management, explain cost of capital, explain the weighted average cost of capital, discuss the marginal cost of capital, define the factors affecting weighted average cost of capital. Capital structure is the proportion of debt, preference and equity capitals in the total financing of the firm's assets. The main objective of financial management is to maximize the value of the equity shares of the firm. Given this objective, the firm has to choose that financing mix capital structure that result in maximizing the wealth of the equity shareholders. Such a capital structure is called as the optimum capital structure. At the optimum capital structure, the weighted average cost of capital would be the minimum. One of the 5 sub-theories proposes that capital structure may be influenced by the organizational life stage of a firm, as financing needs may change with the changing circumstances of the firm. Capital structure management. The capital structure decision influences the value of the firm through the cost of capital and can affect the share of the earnings that pertain to the equity shareholders. The capital structure of a company refers to a contamination of the long-term finances used by the firm. The theory of capital structure is closely related to the firm's cost of capital. To design capital structure, one should consider the following 2 propositions. Wealth maximization is attained best approximation to the optimal capital structure. The term capital structure refers to the percentage of capital, money, at work in a business by type. Broadly speaking, there are 2 forms of capital: equity capital and debt capital. The capital structure involves 2 decisions. Types of securities to be issued are equity shares, preference shares, and long-term borrowings. Relative ratio of securities can be determined by process of capital gearing. On this basis, the companies are divided into 2. Highly geared companies, those companies whose proportion of equity capitalization is small. Low geared companies, those companies whose equity capital domination total capitalization. Internal factors affecting capital structure management. The internal factors which are affecting capital structure are as follows. Cost of capital. The process of raising the funds involves some cost. While planning the capital structure, it should be ensured that the use of the capital should be capable of earning the revenue enough to meet the cost of capital. Risk factor. In financial terms, risk and return always go hand in hand. Whichever capital is cheap for the company is risky for the future company. Costs associated with the borrowed funds may be less, but the borrowed capital is more risky for the company. Control factor. While planning the capital structure, and more particularly while raising additional funds, the control factor plays an important role, especially in case of closely held private limited companies. Objects of capital structure planning. While planning the capital structure, the following objects of the capital structure planning come into play. To maximize the profits of the owners of the company. This can be ensured by issuing the securities carrying less cost of capital. To issue the securities which are easily transferable, this can be ensured by listing the securities on the stock exchange. External factors affecting capital structure management. The external factors which affect the capital structure management are as general economic condition. While planning the capital structure, the company needs to consider the general condition existing in the company. Behavior of interest rates. While planning the capital structure, the company may be required to take into consideration the likely behavior of interest rates in the economy. Policy of the lending institution. If the policy of the lending banks or financial institution is too harsh or rigid, it will be advisable not to go for borrowed funds. Taxation policy. Taxation policy as a factor affecting the capital structure decision needs to be reviewed from the angle of the company as well as the investor. Statutory restriction. The statutory restriction prescribed by the government and various other statutes are required to be taken into consideration before the capital structure is planned by the company. General factors affecting capital structure management. The general factors are described as constitution of company. While deciding about the capital structure, the constitution of the company plays an important role. In case of private limited company, the control factor may be more important, while in case of public limited company, cost factors may be more important. Characteristic of company. Characteristic of the company in terms of size, age and credit standing play very important roles in deciding capital structure. Stability of earnings. If the sales and earnings of the company are not likely to be stable enough over a period of time and are likely to be subject to wide fluctuation, the risk factor plays more important role and the company may not be able to have more borrowed capital in its capital structure as it carries more risk. Attitude of the management. If the attitude of the management is too conservative, the control factor may play an important role in capital structure decision. If the policy of the management is liberal, the cost factor may get more importance. Theories of capital structure management. Capital structure refers to the way a corporation finances its assets through some combination of equity, debt or hybrid securities. A firm's capital structure is the composition or structure of its liabilities. There are four basic capital structure theories. They are net income approach. According to this approach, the capital structure decision is relevant to the valuation of the firm. This means that a change in the financial leverage will automatically lead to a corresponding change in the overall cost of capital as well as the total value of the firm. Assumption of NI approach. There are no taxes. The cost of debt is less than the cost of equity. The use of debt does not change the risk perception of the investors. Net operating income approach. This approach is one of the opposite view of net income approach. This approach suggests that the capital structure decision of a firm is irrelevant and that any change in the leverage or debt will not result in a change in the total value of the firm as well as the market price of its share. Features of NOI approach. At all degrees of leverage, debt, the overall capitalization rate would remain constant. The value of equity of a firm can be determined by subtracting the value of debt from the total value of the firm. Value of equity is equal to total value of the firm minus value of debt. Cost of equity increases with every increase in debt and the weighted average cost of capital remain constant. When the debt content in the capital structure increases the risk of the firm as well as its shareholders. Modigliani-Miller approach. Modigliani-Miller approach, popularly known as the approach, is similar to the net operating income approach. The approach favors the net operating income approach and agrees with the fact that the cost of capital is independent of the degree of leverage and at any mix of debt-equity proportions. The significance of this approach is that it provides operational or behavioral justification for constant cost of capital at any degree of leverage. Assumptions of approach. Capital markets are perfect. All investors have the same expectation of the company's net operating income for the purpose of evaluating the value of the firm. Within similar operating environments, the business risk is equal among all firms. 100% dividend payout ratio, an assumption of no taxes was there earlier, which has been removed. Traditional approach. The net income theory and net operating income theory stand in extreme forms. Traditional approach stands in the midway between these two theories. According to this theory, a proper and right combination of debt and equity will always lead to market value enhancement of the firm. This theory also states that after a level of debt in the capital structure, the cost of equity capital increases. It is an intermediate approach between the net income approach and net operating income approach. According to this approach, an optimum capital structure does exist. Market value of the firm can be increased and average cost of capital can be reduced through a prudent manipulation of leverage. The cost of debt capital increases if debts are increases beyond the definite limit. The effect of change in capital structure on the overall cost of capital can be divided into 3 stages as follows. First stage. In the first stage, the overall cost of capital falls and the value of the firm increases with the increase in leverage. This leverage has beneficial effect as debts are less expensive. Second stage. A stage is reached when increase in leverage has no effect on the value or the cost of capital of the firm. Neither the cost of capital falls nor the value of the firm rises. This is a stage wherein the value of the firm is maximum and cost of capital minimum. Third stage. Beyond a definite limit of leverage, the cost of capital increases with leverage and the value of the firm decreases with leverage. This is because with the increase in debts, investors begin to realize the degree of financial risk and hence they desire to earn a higher rate of return on equity shares. Cost capital. Cost of capital is the required return necessary to make a capital budgeting project such as building a new factory worthwhile. Cost of capital includes the cost of debt and the cost of equity. Cost of debt capital. Cost of debt is the main method of cost of capital in finance and financial management. Cost of debt is calculated on the debt, bonds, loan or debentures by multiplying interest rates with giving amount of debt. Cost of debt without any adjustment, KD is equal to amount of interest by amount of loan into 100. Cost of preference capital. Cost of preference capital are also used to calculate the cost of capital and are the fixed cost bearing securities. In this, the rate of dividend is fixed in advance when they are issued. It is equal to the ratio of annual dividend income per shares to net proceed. It is not used for taxes and it should not be adjusted for the same. Preference shares can be divided into irredeemable preference shares, redeemable preference share. Cost of equity capital. Cost of equity capital is the hardest job to calculate and it also raises lots of problems while working on its calculation. Its main motive is to enable the management, which is to make the decision in the best interest of the equity holders. However, there are various approaches for computing the cost of equity capital. They are the SML approach or CAPM model. This is a popular approach to estimate the cost of equity. According to the SML, the cost of equity capital is KE is equal to KRF plus B bracket KM minus KRF, where KE is equal to cost of equity, KRF is equal to risk minus free rate, KM is equal to equity market required return, B is equal to beta, bond yield plus risk premium approach. This approach is a subjective procedure to estimate the cost of equity. In this approach, a judgment risk premium to the observed yield on the long-term bonds of the firm is added to get the cost of equity. Cost of equity is equal to yield on long-term bonds plus risk premium. Cost of retained earnings. Cost of retained earnings have the opportunity cost associated with it and it can be computed as well without any difficulty. The opportunity cost in this is same as the rate of return of the shareholders, which determined the cut-off point for the deals. It is also the rate of return which shareholders can get by investing after tax dividends in alternative opportunity. Weighted average cost of capital. The weighted average cost of capital, WACC, is the cost of capital that should be used in evaluating projects, is the marginal cost of the funds raised to finance the project, and the WACC is considered to be the best estimate of marginal cost. WACC can be calculated using the following formula, where KEG is equal to is the cost of equity in the GET company, KD is equal to the cost of debt before tax relief, E is equal to the market value of the company's equity, D is equal to the market value of the company's debt, T is equal to the rate of corporation tax applicable to the company. Merits of weighted average cost of capital. The WACC's widely used approach in determining the required return on a firm's investment. It offers a number of advantages, including the following. Straightforward and logical. It is the straightforward and logical approach to a difficult problem. It depicts the overall cost of capital as the sum of the cost of the individual components of the capital structure. Responsiveness to changing condition. Since it is based upon individual debt and equity components, the weighted average cost of capital reflects each element in the capital structure. Accurate when profits are normal. During the period of normal profits, the weighted average cost of capital is more accurate as a cut-off rate in selecting the capital budgeting proposals. Ideal creation for capital expenditure proposal. With the help of weighted average cost of capital, the finance manager decides a cut-off rate for taking decisions relating to capital expenditure proposals. Limitation of weighted average cost of capital. The weighted average cost approach also has some weaknesses. Important among them are as follows. Unsuitable in case of excessive low cost debt. Short-term loan can represent an important source of fund for firm experiencing financial difficulties. When a firm relies on zero cost in the form of payables or low cost short-term debt, the inclusion of such debts in the calculation of cost of capital will result in a low WACC. Unsuitable in case of low profits. If a firm is experiencing a period of low profits, not earning profit as compared to other firms in the industry, WACC will be inaccurate and of limited value. Difficulty in assigning weights. The main difficulty in calculating the WACC is to assign weight to different components of capital structure. Normally, there are two types of weights: book value weights and market value weights. Selection of capital structure. The selection of capital structure to be used for determining the WACC is also not easy job. Three types of capital structures are there, that is current capital structure, marginal capital structure and optimal capital structure. Marginal cost of capital, MCC. Marginal cost of capital is calculation of the cost of additional funds to be raised. Marginal weights represent the proportion of various sources of funds to be employed in raising additional funds. Marginal cost of capital is the cost of raising one more unit of capital. If company raises more capital, cost of capital will also raise. Demerits. It ignores the long-term implications of the new financing plans, fails in achieving the wealth maximization objective in the long run. Factors affecting weighted average cost of capital. The cost of capital is affected by a number of factors. Some are beyond the firm's control, but others are influenced by its financing and investment policies. Controllable factors affecting the cost of capital. These are the factors affecting weighted average cost of capital that the company has control over. Capital structure policy. Firm. Capital structure policy. Firm has control over its capital structure, targeting an optimal capital structure. As more debt is issued, the cost of debt increases, and as more equity is issued, the cost of equity increases. Dividend policy. Given that the firm has control over its payout ratio, the breakpoint of the MCC schedule can be changed. Investment policy. It is assumed that when making investment decision, the company is making investment with similar degrees of risk. If a company changes its investment policy relative to its risk, both the cost of debt and cost of equity change. Uncontrollable factors affecting the cost of capital. These are the factors affecting cost of capital that the company has no control over. Level of interest rates. The level of interest rates will affect the cost of debt and potentially the cost of equity. Tax rates. Tax rates affect the after-tax cost of debt. As tax rates increase, the cost of debt decreases, decreasing the cost of capital. Summary. The firm has to choose that financing mix or capital structure that result in maximizing the wealth of the equity shareholders. The term capital structure refers to the percentage of capital money at work in a business by time. It may also be possible to raise more equity capital in boom, as an investor may be ready to take risk and to invest. Overcapitalization is a situation in which actual profits of a company are not sufficient enough to pay interest on debentures, on loans, and pay dividends on shares over a period of time. The value of the firm is more in the case of lesser overall cost of capital due to more application of leverage in the capital structure.